Please welcome to the stage His Excellency Sheikh Bandar bin Mohammed bin Saoud Al-Thani, Governor of the Qatar Central Bank and Chairman of the Qatar Investment Authority. Chia Der Jiun, Managing Director of the Monetary Authority of Singapore. And Mary Callahan Erdoes, CEO of Asset and Wealth Management of JP Morgan, for a conversation with Bloomberg's Joumanna Bercetche.
Hello again, everybody. Our conversation is going to be about balance and reward. And certainly there's been quite a lot of risk to financial markets this year, maybe not a lot of reward, depending which side you were positioned. Your Excellency, I'd like to start with you, because if there is one word I would say that has come up time and time again in my conversations with people vis-a-vis the global growth outlook, it's been the word uncertainty. So many questions about where all of the US administration's policy decisions are going to lead us, the impact that is going to have not only on US growth, but global growth as well. There has been a bit of progress recently on trade talks. There was a breakthrough of some sorts in terms of dialogue between US and China last week. Where does this all leave us? How do you see the outlook for growth into the rest of this year?
Thank you for having me, Joumanna. As you know, that the global economy is slowing down. And I believe that because due to various factors such as, first of all, geopolitical tension and, declining in working age population in many countries, as well as environmental changes. The recent development in tariffs, as you mentioned, have further compounded on the slowdown. What I believe that we don't know yet what will be, the result of tariffs. So tariffs is compounded, but global economy is already in a slowing down mode. In regard to financial market, I believe that the financial market, we have witnessed, very high volatility in financial market and stock market recently because of the increasing of uncertainties. And unless we have more stable economy, more stable environment, this volatility might, continue. Also, on the other hand, we have witnessed an increased risk of financial instability. I'm not worried about, regulated financial institutions, because they are very well capitalized, very high liquid. My worry is about, non-bank financial institutions and the risk associated with them. This is the area where I'm worried about. I want to highlight as well, that most of the governments, they are in a very high debt level. So it will be difficult for most of the governments those days to support their economy, to support, their financial sector in case of any crisis happened in a place. So my view is that we are in slowing down mode. Is there going to be a recession or not? Technically, we are not yet in recession. Mm-hmm. However, the recent data showing that there is a low probability of a recession in coming future.
Mm-hmm. And recession probabilities tend to move around with these trade discussions. So there's a bit of a correlation going on there. Der Jiun, I'd like to turn to you. On Friday, Moody's downgraded U.S.'s sovereign credit rating. You've now got no single U.S. credit rating agency that has U.S. rated AAA. The dollar is back, it's down about 6% this year. 30-year yields are climbing up to 5%. As a strategic investor, has your perception of safe haven assets in the U.S. changed because of the events over the last couple of months?
Yeah, thanks, Joumanna, for the question. But first of all, great pleasure to be here in Qatar. Fantastic to be in a place where it's so striking in its vision and also in its implementation of that vision. The question, I think, has come up quite a lot, and I think probably motivated by the events between April 2nd and April 9th, where there was a simultaneous decline in US equities, bonds, and the US dollar, when traditionally the dollar has provided an offset to declining risk sentiments. And that didn't happen this time, and it behaved a little bit more as an emerging market asset. That, I think, generated quite a lot of discussion. I think in conversations with market participants, I think there is talk about an interest in rotation and diversification. And these flows have been quite varied. So in Europe, the flows have been about rotation because there's been a relatively more positive story about Europe coming out of a change in policy, and also the relative value in European assets. In Asia, I think the conversation has also been a little bit different, which is that Asian currencies were a little bit hit harder in the first phase of the tariff announcements, and with some of the better news that was coming out post April 9th, with the suspension and so on, there was re-rating of the prospects for Asia. That's one. The second, of course, is that there is generally an overweight exposure to US assets from Asian investors, a lot of it unhedged, in fact, most of it unhedged. And so some changes in that sentiment and the read of the direction of the market can cause an outsized reaction, as did happen in the last week of April, where Asian currencies did go up quite sharply. Now, I think the question going forward is, how do you see this? Is this cyclical? Is this structural? And there are elements of both going on, but we have to disentangle the two. On the cyclical side, markets are pricing in slower growth, prospect of higher inflation in the US, and questions over how the fiscal situation will be resolved in the coming months, and what the fiscal trajectory will be going forward. And then, of course, the rating agency action is a reflection of that uncertainty about the fiscal trajectory for the US. So it's important to resolve those issues.
Yeah, just as a follow-up to that, the Trump administration doesn't like, quote unquote, governments to meddle too much with their currencies. And in Singapore, it's a special case because you set policy via currency. And I just wonder to what extent that has to be factored into your decision-making in an environment where the dollar seems to be persistently weakening.
So we manage according to a basket, and so it's not primarily the US dollar, so it's quite a diversified basket of currencies that we manage against. We manage it against a band, and we're on an appreciating slope of that band. So generally, the Singapore dollar is appreciating against our trading partners. And there's room within the basket for volatility, so we're not overly concerned about the bilateral exchange rate with any one currency pair. And so there is room for us to manage within that. And generally, over decades, we have built up credibility in our monetary policy regime that market participants will take our signal, and usually the market will bring and help us implement that policy and bring us to where we need to be.
Well, Mary, you and I were on a panel in Davos a couple of months ago with His Excellency as well, and we were talking about the outlook for banking this year, and all of the panelists were very excited about the prospects of having a pro-growth administration, what that would mean for the banking sector. And you actually used the term, we've got a war chest that we're ready to deploy. Have you deployed the war chest? How's it going?
Yes, not yet, but I first just wanted to say, I really wanted to thank Mayor Bloomberg and all of the Bloomberg administration here for bringing this to be the 5th annual Economic Forum. It is a really, really important thing, and in many ways, Bloomberg is often in advance of the rest of us. And so, and Your Excellency, thank you so much for allowing us to be with you here today for this very important discussion. JP Morgan has been in the region for 92 years. And we serve across 15 different countries. Right after the great financial crisis, we only had about 100 people here. And today, we have 370, and that'll probably be about 500 in the coming year or two. And it's a very exciting place for us to be. And as a matter of fact, I had mentioned we are going to have the JP Morgan leadership team. There's about 700 of us that are going to come and kick off the year of 2026 right here in this great hotel. So I think it is a very exciting time for everybody to be thinking about this. And I think it very much dovetails with all of the conversations that we've had. Actually, the Prime Minister made a great point, which is the World Cup is very much like an IPO of the country, and you can feel it when you're here live and in person. And I think that there's so many things happening in the world where it is a time of great risk, but it is a time of great opportunity, and figuring out how to navigate that is really important. The conversation about the dollar is an equally important one. U.S. exceptionalism has been something that the U.S. is very proud of. But with the world order changing and reshaping itself as people try to figure out where they are, you have $16 trillion worth of foreigners in the U.S. stock market, and just 1% of that is a $160 billion move in the U.S. dollar. So the thoughts of where the dollar goes, you remember back last August when the yen had its short-term movement problems, and the markets had a very unsettling, rattled time period for a day or two, especially over that weekend, August 7th, I think it was. And so these are times where you really have to think about what is the right long-term asset allocation. You have been very strong in your feelings about weathering the storm, thinking about your long-term asset allocation. I don't think rating agencies change what people are going to think about allocating to the U.S. versus Europe versus Asia, and of course here in the Middle East. I think it's what are the opportunities. You look at the GDP growth of the country here, and we've got a 2.5% rate going north. You got a lot of exciting things. You have foreign direct investments, which you have targets of growing quite nicely, and you have to think about that for your overall asset allocation. And you have to think, how many assets do I have that may have gotten overweight in a particular area? U.S. has seen a great appreciation, and you have a lot of people that are overweight that. And so I think there's really just a readjustment of how people think about their overall asset allocation. A
rebalancing of the portfolio as opposed to a structural move out.
Yes.
Since you mentioned IPOs, I do want to ask you, because trading has been, it's been busy. It's been a good quarter for banks because of financial market volatility.
Yes.
What is the outlook for deal making into the second half of the year at this point?
Yeah, I think we're going to have a pretty healthy rest of the year here. So as we all know, we went through the month of April. 3 of the 4 most volatile days in the stock market ever were in the month of April 2025. So these are unprecedented times for those of you who are new into the marketplace. And it's not normal that you have volumes surge to double or triple the levels that they are trading on average. But those are providing opportunities once the markets resettle to think about where things are going. You see a lot of deal conversations happening. We have been very busy on the capital market side, and I think you're going to see the market start to open up here. We have some happening in Asia, some of the largest that we've had in a long time, and we're excited about it. And I think the markets are ready for it.
Yeah. Your Excellency, let me ask you about the inflation outlook. We spoke about growth and the fact that recession probabilities just in the last couple of weeks have started edging lower again. At the same time, I thought it was interesting, the University of Michigan survey came out showing that inflation expectations have been moving upwards. How do you see the inflation outlook, and obviously relevant given the currency is pegged to the USD?
Actually, there been significant improvement in the inflation in the last couple of years. However, recently, the inflation brought to the table again because of the recent development in tariffs. In my point of view, it's not just tariff, it's about tariff and geopolitical tension. So that's all bring the inflation probability to increase again. today, we don't know yet what will be the impact of tariff on inflation. What is going to be the size, where it's going to hit, how long it's going to take. This is not clear for central bankers yet. So unless we have data about the tariffs and the impact of tariffs in the prices, central banks cannot move forward. But in my view, that central banks, they have the ability and also the willingness to contain inflation in coming future, but there will be slowdown in inflation improvement in the coming few months until the tariffs, tariffs things get settled.
Where do you think the biggest growth drivers are going to come from? We spoke about some of the short-term uncertainties vis-a-vis the outlook, but if you think about more medium-term, long-term, are there any secular growth areas that exist that are away and dislocated from what we're discussing around trade and the uncertainty of trade?
So thanks. Maybe if I can just take 1 or 2 minutes to come to an earlier point about the dollar and US assets on the structural side. So I think in the transition in the near term, there are some pricing in of some of the new developments, but structurally, I think we have to think about the enduring advantages of dollar-based assets. They are the dominant safe assets for use in the financial system, deeply embedded. $28 trillion US Treasury market is fundamental and systemic to the global financial system, and there is no alternative for this point. Now, structurally, how could that change? I think then it becomes a question of the fiscal trajectory and what market participants, how much confidence or uncertainty market participants project onto that fiscal trajectory. And that becomes important. And also other policies that either reinforce confidence or take away confidence in US-based assets. So that, for now, I think is a reasonably stable outlook. But I think the near term is where we have to look for continued market signals. Now, coming to a question about where growth will come from. In the near term, there is still a lot of front-loading going on. We see that in our data, the hard data coming out of Asia. So it's true in China, it's true in Southeast Asia, that the front-loading or the inventory build-up ahead of tariffs that we saw starting from late last year, carried on into the first quarter, and we're seeing that in the April data as well. But looking ahead, I think it will be a story of two halves. There will be a payback for that inventory build-up, and that's probably going to come in the second half. And we're seeing some of the survey-based data soften already. So, the PMIs have already started to soften. So we'll probably see that come through, but there will be sectors that will continue to grow. Semiconductors, for instance. Now, this is a strategic sector. The US wants to onshore more of it, and we're seeing new investment plantings in the US already growing in the data. So even in 2024, before the tariffs, that onshoring will happen. But nevertheless, global demand is big and rising, and there are many concurrent projects that are in the pipeline for semiconductors, some of them in Singapore, and several more in our region. But globally, there are many new plantings that have been planned to meet the demand from AI and the numerous applications of AI in all industries. So semiconductors will still be a growth story.
Yeah.
Yeah, I might just add, I think it's technology in general. His Excellency was telling us about a lot of the exciting things he's seeing in the technology space with people he's talking to. And it's just, you cannot quite calculate the impact of what technology is going to do to all companies. So technology itself is going to be a tremendous investment, particularly in the semiconductor and other space, chips, et cetera. But when you think about the power of what AI can do for all companies to reduce costs, potentially to offset whatever tariffs are going to creep into cost increase, I don't know exactly how that offset will work and whether one will come before the other, and that will be a question of whether the consumer can bear it. But if you think about the ability to drive those costs down through efficiencies in these companies, that's why these multiples have stayed so strong across the board. And then you think to yourself, well, which multiples are higher than the others? And you look at just the dichotomy as an example between the US and Europe, and you say to yourself, well, if AI is sort of the equalizer and it can help all companies everywhere, irrespective of whether the AI technology was made in the US or made in Europe, you could really get a benefit from some of those companies around the world. So I think this is exciting across the board. The question is whether inflation creeps in too fast before that. And a little bit to this inventory point is just something I want to make mention of. There has been a pull forward in purchases, people nervous about tariffs. Let me buy in advance of that. Let me pull forward that inventory that I see. So you've got a little bit that may have been overly frothy, I guess, maybe in these numbers, as you've seen the first quarter, second quarter. You've now had comments from Walmart and the like about how much people will need to pass through to the consumer. Just in the JP Morgan consumer data, we bank half the households in the United States of America, and we have the largest credit card data that we can see on a daily basis. It has not yet affected the very hungry consumer in the US that constantly spends. And so the question will be every day as you watch that, are you starting to see early signs? Are you starting to see a little substitute down and going to restaurant that may be a little bit cheaper? Flights have softened up a little bit. And so all those things are just on the margin to be watched.
I do want to round up with a question, though, because the fiscal situation in the U.S. has come up. Both of our panelists, His Excellency and MD, has spoken about it too. Do you think that just structurally the world is going to have to get used to higher interest rates, long-term interest rates in the U.S. to reflect the fact that these deficits are wide, the debt load is huge, the servicing costs keep going up. It's the second biggest outlay for the U.S. government. And those budget deficits don't seem to be going away anytime soon. So do you think we will just have to live in an environment of higher yields to reflect that, long-term yields?
Well, I think you've got this dichotomy in the world of central banks who have been raising rates, cutting rates. There is a dichotomy already. You've got the emerging markets that's diverged from the developed markets, and then you have places like Europe very different than places like the U.S. Each country has to do what is in the best interest of their mandate. Some have dual mandates like the U.S., which is both inflationary and price stability as well as unemployment, and others just have one or the other. And so as those play out, you get different outcomes of that. I don't think there's one answer that says around the world we're going to have higher interest rates. But those deficits are here, and we have to solve them. We can't keep passing them on to the future generations.
Your Excellency, I'm just going to give you the final word and a few lines about the Qatar economic outlook. And I touched on it earlier with my conversation with His Excellency, the Prime Minister, and we spoke about the World Cup being a sort of IPO moment and some of the bigger plans. But more short term, what sort of an impact are you seeing from global growth uncertainties on the direction of travel for Qatar?
Actually, we are part of this world, and what's happened in the world, there is a reflect on Qatar economy as well. As His Excellency mentioned today in his speech that, and his interview, that we are diversifying our economy. Regarding the recent development, the tariffs and other geopolitical tension, in Qatar we have direct and indirect impact, especially in tariffs. So the direct impact is very minimum. There is no major issue with, despite that, there have been imposed on us like 10% minimum tariffs, because our export to US is less than 2%. So there is no major impact in that area. But my concern is about the indirect impact, which is the decline of energy prices. That could, affect our fiscal budget as well as current account. However, Qatar and GCC, they have very well diversified their economies. We have an ambitious plan to diversify our economy. We already execute that plan. Also, GCC and Qatar especially we have built our sovereign wealth funds that can stand and support our economy if needed. But up to now, and comparing to the oil prices at this level, we are in good stage. But if it goes below that, then there will be a concern.
Let's see what happens. Panelists, thank you so much for the discussion. Thank you.
Thank you.
Thank you.